Hi, everyone. Apologies for the delay, but now here and now very excited about this. Wanted to introduce with Inspira Financial and about how to access alternative investments through IRAs.
Yeah, yeah, thanks for us. I appreciate y'all having me on. Um, I guess I should just go ahead and share my screen and jump into it.
Yeah, absolutely.
Okay, perfect. Let me okay, here we go. Oh, sharing is not turned on. Let me send request. There we go. All right, thank you, sir. Um, there we go. Wonderful. All right. Again, for us, thanks to you and the entire Disrupt team for allowing me to be on here and for Inspira to kind of be a partner in the self-directed space. We're certainly excited, to have a hand in the education that you guys do. I think that's such an important piece of real estate investing, private equity, alternative assets, everything that's involved there. Everybody starts somewhere, right? And so the education and knowledge that we acquire learning how to do this is incredibly important. So, like I said, I'm glad to play a part in that. What we'll be talking about today specifically is how you can invest into real estate through retirement dollars, IRAs, 401ks, 503Bs, whatever it might be, a TSP plan. There are a ton of options out there depending on, maybe the type of work you do or have done in the past, saving and things like that through IRA accounts. And plenty of other, good tidbits that I'll provide. So we'll I guess I'll just jump into this here. Um, let's see. So, um, a quick disclaimer, which basically just says that, Inspira as a third party is not here to provide any sort of tax, legal, or investment advice. We are not, supporting or condoning any particular type of investment. This is purely for educational purposes and hope that you take it as such. But we would certainly like to impart the right ideas and information on how people can utilize this and why it's advantageous. Um, a little bit about me before we really go into the kind of meat and potatoes of the presentation, talking about defining what a self-directed IRA is, what you can do with it, all of the good stuff, how it can be done, and then we'll also kind of talk about go into a case study, and I'll just share a little bit briefly about Inspira to wrap up at the end as well. So like for us mentioned, my name's Collin Taylor. I am a certified IRA services professional with Inspira Financial. I work in our self-directed alternative custody side of the business. Inspira does a lot of different things, and I know that for many of you, especially for maybe the local custodians, I'm in Houston myself. Was born and raised here, and I've been kind of exposed to the real estate industry for a long time. My parents began real estate investing when I was pretty young, and I kind of saw the impact that had on my family. They were doing their own rehabs, fix and flips for a long time, and now they actually invest into some other real estate asset classes just outside of single family. But I really got to see firsthand from them, how impactful and valuable and successful they were with it. So that certainly kind of sparked this interest in me into private assets, right? And so I went to Texas A&M where I got my degree in ag economics, and I did a minor in financial planning. And so through that, starting financial planning, kind of like holistic financial planning, right? Risk management, portfolio management, estate planning, tax reduction, all of that good stuff. I found my way into the self-directed space sort of by hapstance. I actually interned with a group who was by the name of Quest Trust Company. So Quest was here in Houston for many years, over 20 years, we were a local custodian, had offices all around Texas, and were acquired about a year and a half ago by Inspira. So a lot of us made our way to Inspira by way of acquisition. You know, we worked with Faraz and the Disrupt team a lot under Quest, and that was always a very very good relationship. So we're extremely excited to be continuing that here. But that's just a little bit about me, my background, why I'm qualified to discuss this topic. And I guess one other thing I should mention before we really get started is Happy St. Patrick's Day. I know that I'm wearing my green, making sure I'm not getting pinched today. So, with that being said, we'll kind of dive in here. So, first discussing the what and the how, more specifically, what a self-directed IRA is, why that matters to you, right? We'll talk about the advantages and the restrictions, and some of the other components of these accounts, what makes them unique. And to be completely honest, there isn't a whole lot of uniqueness to them. What we're talking about is really just a type of retirement account in which the custodian, in this case Inspira, would be allowing you to control or have a little bit more say or flexibility in the type of investments that you're doing. So what I mean by custodian is the company that custodies the IRA or the assets within there. So the best way to think about Inspira is probably to compare us to a group like Charles Schwab or Fidelity, right? Vanguard, Merrill Lynch, JP Morgan. There's a ton of them, but we operate the same way. We hold IRA accounts. We allow investors to make investments through those. We just offer a little bit more of a diverse or a different kind of asset selection, right? So we have people that are investing into, um, you know, apartment complex syndications and single family, rental properties, Airbnbs, people doing options and futures and forex trading. There's a cryptocurrency. We have a lot of different things. Private lending, right? There's a whole lot you can do with a self-directed IRA. It's almost to the point where if you can dream it up, we can help you make it happen, sort of thing. Now, maybe not quite that dramatic, but there's a whole lot that you can do and that we see. So we're really helping folks kind of direct their funds outside of the public investment sphere, stocks, mutual funds, ETFs, right? That's where you would typically typically place money or investments with a group like Charles Schwab. So we're just offering a more unique type of investment. So that term self-directed is really just something we use more for marketing purposes. Our IRA accounts are not any different. The IRS does not, see them to be anything distinct from an IRA at Schwab. So it really just comes down to what the custodian is allowing you to do. And in this case, with Inspira, we allow for private real estate investments. So it's again, yeah, just putting you in the driver's seat to control what it is that you want to invest into. Um, Past that, there are several different types of accounts, right? There are different IRAs and obviously ones that we offer, which you can technically self-direct, right? The two most prominent would be the traditional and the Roth IRA. Those are accounts that most people are familiar with, and probably a very important place to make I think a comment on the tax advantages of these accounts, right? That's why we see people who um, maybe are already very experienced real estate investors wanting to use a self-directed IRAs for the tax advantages, just like you might have with, your 401k through your job, traditional Roth IRAs elsewhere. That's all the same, and that's one of the biggest advantages. Um, of these accounts. I'll kind of talk here, and I think the next slide about, or maybe two slides about some of the other advantages, but tax savings is one of the biggest, tax sheltering. Um, I think it's important to make a distinction here to help those understand that are not familiar with the way that tax advantage through retirement accounts work or qualified plans. Because there are two different types, right? Um, there's tax deferred growth and there is tax free growth, technically. Traditional and Roth IRAs, I think is always a great way to point this out because these two accounts are very, very similar. The personal IRA plans, generally anyone can have one as long as you have a, social security number, and enough money to contribute to them, which is generally just any sort of income. And same contribution limits, generally the same distribution rules for the most part, with some exceptions, and there are other factors too. But these accounts are very similar in most ways, other than the tax growth, where they really lie on opposite ends of the spectrum. And so there are, I mentioned, two different types of tax growing ability through a qualified plan, a retirement account, and IRAs are no different. So the traditional IRA is what we refer to as a tax deferred account or a pre-tax account, meaning that money that is going into there, you are depositing or putting into it before taxes. So you're not paying income tax generally on those funds. The way that works is a lot of times you are putting after-tax money into it, but you get a deduction, right? That the IRS awards you a deduction for that contribution into a traditional IRA. And that's what technically makes it a pre-tax contribution. So you put money into it before taxes, it's allowed to grow, earn money or earn earnings, and investment return through that traditional IRA for the life of the account. As long as that money is in there, it will not be taxed, generally speaking, as far as like, your typical income or capital gains tax. Those funds won't be taxed as long as they continue to grow within that traditional IRA. It's not until the end of the account life cycle, if you will, typically when that account holder is in retirement, they're now starting to need that money to live on, right? They're withdrawing it, as is the point of these accounts. That is when the funds get taxed, when you start to pull it out. So traditional IRAs or pre-tax IRAs are not taxed going in, but they are taxed coming out. And Roth IRAs are, like I said, almost the exact opposite of that. They are taxed dollars going in, so post-tax when you contribute it into the Roth, and down the line, the advantage of paying your taxes up front is that you can potentially take out everything from your Roth IRA, completely tax-free, tax and penalty-free. As long as there are two qualifications that you meet, which are fairly straightforward. You have to have attained 59 and a half years of life, 60 years old, right? And had that Roth IRA open and funded for 5 years. So if you put, a dollar into a Roth IRA when you were 30 or whatever it might have been, you can eventually access that money without having to pay any tax or penalty. Even the growth, even the money that there's money in there that's potentially never going to be taxed. And so that's the advantage of paying your taxes up front as opposed to doing it at the end of the account life or down the line, which is what you would be doing with a tax deferred type of retirement plan. So hopefully that kind of highlights the taxability of these accounts. So traditional and Roth IRAs and SEP and simple IRAs are both pre-tax plans as well. Those are specific to solo entrepreneurs, self-employed individuals, people maybe even running a small business. These are what we call our employer plans, our IRA employer plans. So, more similar to like your typical 401k in some ways, just on a much smaller scale and with some different rules and restrictions as well. Usually less restrictions, but certainly some different rules. For those that may find that applicable, I would certainly encourage you to do some research on it, find what fits you best, maybe even have a discussion with somebody, an expert. Happy to um, provide some information in that regard and have a discussion for anyone that's interested. So those are the type of IRA accounts. Now, this is not an exclusive list. There are other things we do like HSAs, um, and what is that? ESA. There are the new Trump plans that are haven't rolled out yet, but as we kind of get more I guess legislation around that, we'll see how those go. But that's something that we'll probably entertain as well in the near future, kind of like children's Roth IRA accounts, for saving up for your children for college or whatever it may be. So, going into the type of investments that you can do, I alluded to this a little bit already. We are doing things outside of the traditional stock market, whereas, your typical type of retirement account is investing into stocks, ETFs, mutual funds, CDs, bonds, all of that stuff, right? Equities. We are allowing a more unique type of investment, private equity and debt deals, loans, marketplace lending, real estate is again a big one. Commodities and futures trading, I kind of already mentioned, hedge funds, right? Any sort of private deal, like private stock is another one that we see fairly often. DSTs and things like that. There are a lot that there's a lot that you can do on the private side. It really just depends on what your interests are, what your experience is in, and generally, if that's outside of public, public investments, which is the case for a lot of people, there's a way to do it. So that is just kind of the difference between the asset selection that we have here versus what you would have at a traditional investment custodian. So here are the benefits. We can talk a little bit more about these. The tax benefits I already went into, and again, that's really the main reason why somebody would want to do this type of investment in an IRA versus outside of it is for the tax advantage. The other two apply more so to people who are going to be investing with qualified money with a retirement account and why they may want to do it, through a privately held asset. Or something that's maybe a little bit outside of the stock market. And that would be the portfolio diversification, right? Getting some money out of the market where it's a little less impacted by that volatility of the stock market. It may be a little bit more well diversified, right? Things that are not quite as um, tied to the S&P 500 and the Dow and all of those other indices. And then the third one would be the financial autonomy, the ability to really control what you're investing into, especially for those of you that have experience with investing in multifamily or single family real estate or whatever it is, right? That is incredibly powerful. So those would be the advantages. Now, let's also kind of discuss on the flip side of that the restrictions. I don't like to use the word disadvantages, but I guess they could be viewed that way. But there are some restrictions that the IRS has on these accounts, right? They certainly are always very careful not to let anything be too powerful. So with these tax advantages that they're providing. There are some restrictions really on who you can invest with and what you can invest into. So the IRS says that there is a subset of persons, which includes, what you and I would consider people, as well as some of the entities that they're involved with. And these are what we call the people restrictions, or more specifically, the disqualified persons. That's what the IRS would refer to them as. So these disqualified persons would be yourself as the account holder, as well as your spouse, lineal ascendants and descendants, as well as the spouses of your lineal descendants. So anybody up and down the family tree is really what that means. Grandparents, parents, kids, right? A son or daughter, and then in-law, spouses of them. So son or daughter-in-law, grandchildren, even all of those people would be considered disqualified. It also extends to any entities that those people are associated with for the most part, right? So, for example, if I wanted to accept some IRA capital into a fund, a private real estate fund that I was managing, um, my wife would technically be considered disqualified from being able to use her IRA to invest into that because of my relationship with the fund. Right now, she could use her IRA to invest into somebody else's fund, a friend's fund, a third party, right? But not my own kind of private fund that I'm managing. So now to help detail that and color it up a little bit more, the type of investments or type of transactions that these people cannot do are what we call the transaction restrictions, right? So these would be any sort of selling, exchange, or leasing of property between these two parties, that being the IRA and the disqualified person, lending of money or extending credit, as well as furnishing goods, services, or facilities. So all of these things could be considered disqualified per IRS rule. And then the third one here are the investment restrictions, not as closely tied into these other two. These are the two types of assets or asset groups that an IRA cannot invest into, at least not your typical IRA. And that would be life insurance contracts and collectibles. So collectibles could be artwork, jewelry, maybe, vintage vehicles, trading cards, anything that you may typically have a harder time putting a valuation on is a good way to think about it. So no life insurance or collectibles in these accounts as well. Um, so hopefully that gives you a better understanding of what a self-directed IRA is, how it's used, why people use it, what makes them advantageous, what I should not be doing through my self-directed IRA as well, right? That's almost just as important. So um, that is the what, that is the basis for this conversation today. Um, and I also want to help explain how, like what would be the next steps for somebody that's interested in doing this or interested in looking into it a little bit more, right? The first part of that is selecting a custodian that you trust, somebody that not only that you trust, but also fits the criteria that you're looking for, whether that be the cheapest fees or the best service or somewhere in between, right? Finding a group that allows you to do the type of investments that you're looking for, whether that's on the private side or the public side. All of those are important factors. You also want to consider the safeguarding of your assets, right? What happens to your IRA if that company were to go bankrupt? All important considerations. Do they do your typical, IRS tax reporting and filings, 1099-Rs, 5498s? How do they administer the account, right? What, is it to your liking? Do you appreciate the way that you interact with these people? Do you have a point of contact with them, or you're just calling a general line every time you want to talk to them? So all of those things are great considerations. Selecting a trusted custodian is an important part of that step. So Now that you've done that, now that you've figured out who you want to, do business with, right? These are kind of the steps that most custodians would have in the process. So I guess even before that, maybe you identify what type of assets you're investing into, and then comes the step of selecting that custodian. After you do that, it's fairly straightforward to set up a self-directed IRA, right? Fill out an application, do it online, complete an account opening for the IRA. Then you can fund it, and there are different ways that that is made possible, which I'll discuss here in just a moment. And then lastly, being able to invest in whatever sort of alternative type of investments or public investments that you're interested in. Um, so that those would be the, I guess, a very general way to explain the five steps in doing this. So going back to this fourth step here, funding your self-directed IRA. This is an important point I want to make, because it talks about the different ways that you are allowed to put money into a retirement account. So number one would be a transfer. And when we're discussing IRAs, a transfer is any kind of like-kind movement. So moving a traditional IRA from Fidelity to a traditional IRA that I have at Inspira, that would be an IRA transfer. Um, if I'm moving something like a 401k, a non-like account, pardon me, a 401k, 403b, a TSP plan, any of that, a TRS, for our teachers here in Texas, those would be a rollover. So I'm rolling over a plan from one type of account to another. It's still staying in a qualified retirement plan. There's really not a it's not necessarily a taxable event as long as you do it the right way, because it is going from one account to another. You're not ever, technically taking physical receipt of the funds usually. Um, so it's not a taxable event. But the third one would be contributions. So this is money that is not already in an existing retirement account, right? Typically, in a checking account, it's coming out of your own pocket, maybe from the paychecks, the earnings you're making as an employee or whatever it is, and making contributions into that IRA. So not pre-existing retirement dollars. Those would be the three different ways that you can look generally to fund these accounts. So with that being said, I do, let's see, we're 12:30, and hopefully we'll leave some time here for questions. I'm more than happy to answer any, or, if I'll share my information at the end as well for those that have questions, want to email me, call me, whatever makes the most sense. But let's jump into this, and then I'll just share a little bit about Inspira and leave y'all with some parting information as far as what the next steps would be, how you can utilize something like this. And this is just a very, very general case study, kind of very high level, if you will. But in this example, Daniel is a 45-year-old director of sales for a consulting company. He used to work with a lady named Ashley, who comes to him with an opportunity to invest in her real estate limited partnership. Now, Daniel doesn't necessarily have any liquidable or personal funds that he has available to deploy into this deal, but he does have a retirement account from a former employer that he may want to allocate into her investment. I would like to kind of pause here because I think it's important to make this distinction about types of rollovers. Going back to this item right here. Rollovers are generally accessible to plans that are no longer active, right? If you still have a 401k with a current employer, it's still actively being contributed to. They're the ones sponsoring it, right? It's not from a previous employer, or somebody that you've switched companies, left your job, you quit, you retire, get let go, anything like that. If it's still an active plan, you may be restricted in how or how much you can roll over from that plan into another. And really those that typical 401k rules or retirement plan rules can differ depending on the plan, who administers it. There are a lot of different factors. So it's usually just best to check with your administrator, or whoever has knowledge in the plan. Sometimes like your HR or payroll team is best for that too. And they'll have, usually the knowledge or at least the wherewithal to figure out what the rules and restrictions are regarding rollovers, and if they allow for what is called an in-service rollover while you're still in service with the company. So, but Daniel doesn't have to worry about that, right? Daniel has some funds from a previous employer that he wants to invest. Great. He certainly have access to do that. So after conducting some due diligence, he decides, this is my custodian. I'm going to go ahead and set up this account, right, and make this investment with Ashley's limited partnership. So Ashley connects him with this custodian that she works with. He opens a traditional IRA that he can then roll over 200 grand from his old 401k account, and use that to invest in Ashley's partnership, excuse me. So now that the deal's done, every year, any income, profits, and appreciation from this deal that Daniel's invested into with Ashley are deferred from any taxes, right? Not subject to capital gains, income tax. That value is able to then compound. That's when we get into talking about compound interest, being able to make interest on your interest, and then interest on that interest, and then interest on that interest, right? And letting it compound, grow, right? Interest continues to earn money. That's what can make these valuable, is because you're not having to pay tax. You have more interest to be earned, more interest to compound. Um, so because Daniel is investing this through a traditional IRA, he will eventually be taxed on the gains when he starts taking withdrawals from this traditional IRA plan. And that's just taxed at your marginal tax rate, ordinary income tax rate, depending on whatever tax bracket you're in. That is how those funds get taxed. What makes that advantageous is generally people withdrawing from these IRAs are doing so in retirement, right? They're no longer working. Usually their tax bracket's a little bit lower, um, for the most part. So that is kind of the advantage of the pre-tax or tax deferred plans. Um, those gains, that he's earning from this deal can be reinvested, maybe directly with Ashley. They can be invested into other alternative assets, and then that cycle can continue to repeat. So to give you kind of a depiction of how these accounts can grow, for purposes of this illustration, we'll assume that there's an 8% annual return on Daniel's initial investment of 200,000, which in 5 years, right, we're assuming no taxes, no withdrawals, nothing's taken out, everything continues to be reinvested. That 200,000 could turn into $300,000 in just 5 years, 430 in 10 years. And by the time that Daniel's going to retire in 15 years, right, because remember he's 45, that 200,000 could turn into 630,000. Now imagine if he does this through a Roth IRA, where that 630 he can now have access to completely tax-free when he's in retirement. And that's the power of the Roth. So depending on your working years, life expectancy, sometimes even risk tolerance, tax bracket, your current tax bracket, there are certain considerations that go into whether you're more suitable, or I guess rather a traditional Roth IRA is more suitable for you, which one would make more sense. But that's certainly a more individualized discussion, I suppose. So to kind of wrap a bow on this in discussing who Inspira is, I just want to leave you with a little piece of what makes us valuable and unique. So Inspira has a lot of experience. I mean, the company itself was formerly known as Millennium Trust. So Millennium rebranded 2 or 3 years ago into Inspira Financial. And this was kind of around the time that Millennium was doing some acquisitions. They were actually merging with a company called Payflex, who does like corporate health plans, HSAs, health and benefit type of services. And Inspira has kind of morphed into this more one-stop shop, if you will, this holistic financial services corporation doing IRAs, some employer plan accounts, 1031 exchanges for you real estate investors. There's a whole health and benefits side, which is kind of what I mentioned. But Inspira has not only had the original Millennium team that was doing self-directed IRAs, but they acquired a couple other custodians. I mentioned Quest already, which was here in Houston, and then Newview Trust out of Florida. So there's a lot of experience between the three different groups that have all kind of come together in the last year and a half. Um, and expertise that goes along with that. So we have really become one of the leaders, certainly in terms of like asset security, financial strength. We're one of the largest custodians in the space now, specifically in private custody, self-directed IRAs. Just to kind of put some numbers to that. So Inspira has been around, what I guess really about 20, almost 25 years now. Started back in 2002. There are $62 billion in assets under administration, over 8 million different account holders with us, whether that be individuals, families, offices, companies. There are 8 million different client accounts. $40 billion in total under just the alternative custody, the self-directed IRA piece. So that 62 billion is the company as a whole. 45 billion under custody specifically to our alternative assets team. And 75,000, over 75,000 IRA account holders in particular with us. We also have over 40,000 different types of alternative assets that are held here. Um, so this is, as far as like players in the space, one of the largest that you're going to find, and so that again brings just kind of the stability, especially in our industry, which has just been a little volatile, right? There have been a lot of other acquisitions outside of just the two that I mentioned, not pertaining Inspira, but a lot just in general. So I think that stability is important right now. And I think that's actually all I have. So I guess for us, I suppose I can leave this up for a second, but my phone number, email, all that stuff is there. Happy to answer any questions or connect you with one of my team members who can be more hands-on with the process and being a point of contact for you. And yeah, just happy to be in touch and help any way that I can. Love to be a resource for anyone.
Thank you for that, Colin. A lot of great information there, and we do want to open it up to questions to the group. If you have any questions, feel free to type it into the chat, and Colin will be happy to answer.
Yeah, absolutely. Let's see if I can pull up the chat here.
I don't see any yet. I guess we don't have any questions. Oh, here we go. Uh, we have, you can type it into the chat.
And if not, my information's there. Feel free to take it down. I'm happy to have a more personalized conversation with anybody about anything regarding alternative assets or IRAs or qualified plans, whatever it might be.
Yeah, absolutely. Well, no, thank you very much for joining us, Colin. And a self-directed IRA is a great tool that a lot of our investors use here at
Yeah.
Disrupt, and it's very powerful. And thank you for sharing that. And yeah, if anyone has any questions, feel free to contact Colin. And we will have this Investor Power Hour next month, typically the third week of the month. So if anyone does have any questions for us over here, team@disruptequity.com. Or if you have any questions for Collin, collin.taylor@inspirafinancial.com. All right.
Perfect.
Thank you. Thank you.
Yeah, thank you for having me, Ross, and again, happy St. Patrick's Day to everybody on.
Yeah, absolutely. Thank you very much.
All right, y'all take care.